Welcome to CRE Newsroom Weekly Update.
Principal Financial Group is reportedly preparing to raise $3 billion across two new data center funds, with around $2 billion targeted in the U.S. and $1 billion in Europe. Bloomberg says the funds would be managed by Principal Asset Management and are being positioned to capture continued demand for digital infrastructure linked to the AI boom. The broader market backdrop remains supportive, but not without constraints. Vacancy is tight in both the U.S. and Europe, while power availability, grid connection delays, and long delivery timelines continue to shape where capital can be deployed. That matters because data centers are no longer being judged only on location and tenant demand. The decisive questions now are access to power, speed to delivery, and whether operators can bring capacity online quickly enough to meet pre-lease demand.
Principal is not entering this market from scratch. The firm says it has invested in data centers since 2007, and it closed a $3.64 billion dedicated data center fund in early 2025, giving it a visible track record in the space. The move also fits a wider pattern among large private capital managers. Blackstone, for example, has continued to expand its digital infrastructure exposure, including a major Pennsylvania investment announcement in 2025, which shows how competitive the sector has become for institutional capital. In short, Principal's new fundraising plan appears to be a continuation of a longer-term strategy rather than a one-off trade. It reflects a market where demand remains strong, supply remains constrained, and large investors are still working to secure exposure to a sector they believe can deliver attractive long-term returns.
British Land and Royal London Asset Management Property have just secured a major new tenant for their flagship life sciences hub at One Triton Square. The robotics and AI firm Humanoid has signed for 42,000 square feet of specialized lab and office space. This lease represents a massive physical expansion for the company, which has grown its footprint from just 3,000 square feet to 42,000 square feet in only 2 years. Humanoid focuses on developing advanced robotics and AI systems, and this move places them at the heart of London's premier innovation district. This signing is part of a rapid transformation for One Triton Square. The building was formerly occupied by Meta, the parent company of Facebook, who notably paid £149 million to surrender their lease as part of a global streamlining of their real estate portfolio.
However, the vacancy is being filled quickly by the next generation of tech giants. Humanoid follows in the footsteps of the AI powerhouse Anthropic, which took a significant 158,000 square feet in the same building just last month, according to British Land's recent announcements. The cluster effect at One Triton Square is becoming evident. By securing both a major frontier AI firm like Anthropic and a specialized robotics firm like Humanoid, British Land and Royal London AM are successfully pivoting the asset from general corporate tech into a high-spec hub for the applied AI and life sciences sectors.
A consortium comprising LondonMetric Property and Schroder Real Estate Investment Trust, REIT, has reached an agreement in principle for a major strategic acquisition. The consortium has agreed on the key financial terms of a non-binding offer for Picton Property Income. The deal values Picton's entire issued share capital at approximately £403.4 million, which translates to 78.2 pence per share. This is an all-share offer, where Picton shareholders would receive a combination of new shares in both acquiring companies. Specifically, for every Picton share held, investors would receive 0.19 LondonMetric shares and 0.881 REIT shares. This price represents a 7% premium to Picton's closing price on May 11, 2026.
Under the proposed terms, the Picton portfolio would be divided between the two buyers. Schroder REIT is expected to acquire 54% of Picton's gross asset value, while LondonMetric will take the remaining 46%. The move follows a strategic review launched by Picton in January 2026 to address what its board described as a persistent valuation disconnect in its share price. For SREIT, the deal is particularly transformative. It is expected to swell their portfolio by roughly £375 million and materially improve market liquidity. The board of Picton has stated it would be minded to unanimously recommend the offer to shareholders should a firm intention to proceed be made. Additionally, TR Property Investment Trust, which holds an 11.4% stake in Picton, has already signaled its intent to vote in favor of the deal.
Before we move on to the next story, if you're finding this useful, please subscribe, like, and share this with someone else who follows the market. Your support really helps me continue producing these commercial real estate updates. ICG has completed the purchase of a 5-asset distribution portfolio from the South African-listed Equities Property Fund. The transaction is valued at approximately £200.5 million. The portfolio spans a massive 1 million square feet of prime logistics space, with the deal reportedly reflecting a net initial yield of 5.5%. This conclusion comes after a period of sustained negotiation. Market observers note that talks between ICG and Equities had been underway since March 2026. This acquisition is part of a broader, high-velocity streak for ICG real estate. Beyond equity plays in logistics, the firm has been exceptionally active in the debt markets.
Recently, ICG provided a significant debt facility to support a major data center transaction at Foxborough Park, reinforcing the theme we discussed earlier regarding the surge in digital infrastructure. Furthermore, they have extended their reach into the living sector, recently facilitating a development loan for a new residential project in Swiss Cottage, London. For Equities, this disposal represents a strategic capital recycling move, allowing them to deleverage and focus on their core South African portfolio. For ICG, it cements their position as a multidisciplinary powerhouse, capable of navigating complex logistics equity deals while simultaneously bankrolling data center and residential growth.
Agency firm Knight Frank has been officially appointed to sell the Metrocentre in Gateshead, one of the largest shopping and leisure destinations in the United Kingdom. Spanning a mega-sized 2.1 million square feet, the Metrocentre is a titan of UK retail. For decades, it was a flagship asset for the Into REIT, but following that group's high-profile collapse in 2020, management was transitioned to Sovereign Centros, now part of CBRE. Currently, the center is held by a partnership where the Singaporean Sovereign Wealth Fund, GIC, is a major shareholder, having originally acquired a significant stake for £1.2 billion back in 2007. The church commissioners also retain a 10% interest in the freehold.
The formal launch comes with an understandable price adjustment, reflecting the current market. While GIC's entry price was much higher, the asset is now reportedly being marketed with an asking price in the region of £450 million to £500 million. The primary driver for the sale is the looming debt stack. The center is encumbered by approximately £485 million in interest-only, fixed-rate securitized debt within the Into Metrocentre Finance CMBS. Market reports indicate that the total securitized debt outstanding against the center, including various notes and liquidity facilities, is approximately £693 million. Despite the debt challenges, the Metrocentre has seen a significant operational turnaround. Since 2020, over £60 million has been invested in upgrades, including major solar schemes and new EV charging infrastructure. With Landsec recently confirming interest in major UK malls, all eyes will be on whether this mega mall can anchor a new era of retail investment.
That's all for today's update. Thanks for watching, and I'll be back with more CRE and capital markets news in the next video.